The way that I approach what I do in business is I believe that if I do the right things consistently for the right reasons, then ideally everybody wins. I would like people to think more, particularly if we think in terms of, we'll say passive investing, but just decision making in general. It's possible to make poor decisions and get a positive result. Deep value generally means looking for something that is sort of left for dead, that is probably struggling as a company, and you're looking for a turnaround.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
You're a portfolio manager. What's your perspective on the whole thing? Like, the last several years, it's been a, U.S. mega cap dominated market. And we're like last several years, it's kind of like been 10 years like that.
Yeah.
Like it's been a long time, right? Like if you have had diversification in your portfolio, it's kind of burned you. Like you're probably not loving it, which, the old adage about diversification means, it means having something you don't like,
Well, it's insurance.
But, well, I don't know that it has to be insurance, right? Because
Sure. That's a bad.
Yeah, I'm going to call you on the carpet on that one, Seth.
That's fine.
I think about diversification as, can I have two assets that have a natural tendency to go from the lower left corner to the upper right corner, right, of the chart over time, right? Not every day, not every month, not every quarter, not every year, but over time, right? They both go up, and the diversification comes from what is driving those things to go from lower left or to lower right, or sorry, lower left, upper right. Like in general, is the forces that's driving one part of my portfolio the same dynamics that's going to cause another part of my portfolio to have that positive return, right? And so if you can get the inputs of what drives return different in different places, then you can get diversification effect, right?
Yeah.
And so diversification doesn't necessarily, in my opinion, mean owning more stocks, right? Like when you talk to some portfolio managers say, well, we own 50 stocks or 100 stocks, or we own 200 stocks. It's a well-diversified portfolio. And I'm like, yeah, but if they're all reliant on, Congress passing a spending bill to go up, then, how much diversification do you have? You have maybe muted beta, you have maybe lower day to day, but if Congress doesn't pass the spending bill, you have sort of some idiosyncratic risk in your portfolio at the index level. I don't know. I've never really thought of that as a term, but that's sort of what can happen, right? I don't know. What are your thoughts on? Am I crazy?
No. I am an aspiring reformed perfectionist.
Okay.
And therefore, I don't know why I said insurance. I think I was thinking about a prior conversation I had. I think a diversification, if I'm building a portfolio and we help advisors or clients build diversified portfolios. And the way that I do it is to try to find best in class strategies, managers that are different. Ideally I'd like, the morning, as much as I dislike the Morningstar boxes for certain reasons, it can provide a helpful map to just sort of give a sense of kind of where you sit, where your exposure is.
Yeah.
If you're trying to get a good glimpse of where those idiosyncratic risks are or the correlation. But again, as a perfectionist, I want the best.
Sure.
So I want the best strategies that are different, doing different things. And actually, an interesting point that I've been thinking about recently is I went to business school, and one of the coolest experiences was the diverse backgrounds. I was very unique. I was the only person with my background, partially because I have a weird background. But in general, they were diverse viewpoints. And that's really the beauty of diversity, right? We think of diversity in different ways, but really it's the diversity and thought. And if you bring it back to strategies and portfolio construction, if you can get managers strategies that have a diversity and approach and thought, but still have merit, obviously they're hopefully still very good. But
Yeah.
if you can get strategies, even if they're in the same space, but they're approaching the world or they view the world very differently, that's cool diversification.
Yeah. Uh, I think it's a different way to say, I think what I was getting at. That's an interesting thought path to get there. But I think it makes sense, right? So a simple way to essentially say that is you could take two people that trade S&P 500, and one guy's believes in trend following, so he's got a system for trend following, and the other guy trades mean reversion. They're both trading the exact same market, and they both might have a similar annualized return over time or a similar result, maybe even a similar, max drawdown or risk metrics. But because they're approaching it from a completely different angle, right? Like, for whatever reason, the mean reversion guy never trusts the trend, but he likes buying, deep sell-offs and selling big rips. And, one guy says, yeah, it's just easier to ride the trend. The trend is your friend, kind of happy-go-lucky guy or whatever, right? Like they just look at the world differently. And so they've come up with two different strategies that paired together tend to complement each other and have a really great diversification effect that lowers your overall risk, right? I think the really secret is if you can find some stuff like that, but maybe people are even trading different markets.
Definitely.
Ideally you don't want to have people trading the same market, but sometimes that's, the best option still too. So anyways, okay. So you said you have a really interesting background. Tell me about your background. I'd like you to expand on that. I'm interested.
My background is not something I generally go into on professionally.
Where'd you go to school?
I went to school at UNC.
Okay.
And my father was in the markets. He created a strategy that he has managed or that we've managed for 4+ decades. And I grew up kind of hearing about stocks and sort of looking over his shoulder. And that got me into stocks at a young age. And therefore I considered business, but it just didn't really interest me. Whereas math was always, it was just what I enjoyed the most. And so I majored in operations research largely just because I had fun doing it. I had fun kind of with the problem solving aspects of it. Technically, I guess I majored in decision-making scientists or sciences, which is a combination of operations research, math, statistics, and computer science. Did that, then in a roundabout way became an equity trader in New York. And at some point, and I always had this trading firm was generally trading, right? It was shorter term. That was the approach they wanted you to take. I was a little bit of an anomaly and always had a little bit of a longer term focus.
Yeah.
And was also perpetually kind of looking for where the inefficiencies lie. And so I eventually settled on sort of a three-pronged strategy, which they kind of created technically a hedge fund around. One of which was shorter term trading, because I'm the guy that you just mentioned as far as playing mean reversion, buying the dips, selling the reps, which is great maybe overall, but can be very painful at times. I did that. I was fairly good at that, but I found it kind of mind-numbing at times. And so I guess maybe to entertain myself, but also challenge myself to find different opportunities, I also went the exact opposite, where I was doing very deep value in small and micro caps, because I figured as sort of a PM that's doing research also, it's going to be hard for me to unearth something that someone that has a team of analysts looking at Apple all day, every day. It's just, that was going to be hard to compete. And so looking at less covered companies where there's more inefficiency. And again, I was I was good at trading also that inefficiency. So that was another sort of that was an area of that I felt that I could add value. And then I split the difference and kind of went sort of swing trading as far as finding unique groups of stocks that would trade together in certain ways. And so it was really those three different approaches kind of ensured that I always had something interesting to do. Each one seemed to, add value, and they were very uncorrelated.
Can we talk about the small cap and micro caps for a minute?
Sure. Yeah.
So do you think there's still edge in that? Do you think there's still like, because look, I mean, I'm going to just, the elephant in the room, right? The last 10 years, 15 years, if you've owned small cap, you've done okay. You haven't made like no return, but it's been really underwhelming. It's been, and active management's been really tough in the space, just in general. Like active management in equities, as far as like stock picking, has become increasingly difficult as the adoption of passive has grown, right? Do you like, so it was your experience in small cap that, less institutions were looking at it. And so you could find edges and dislocations and deep value, or, did it fizzle out and it's kind of something you gave up on, or what was your overall experience?
As you know, I moved on at some point. I decided that at the best of times, I felt like I was playing a high stakes video game, and wanted something more fulfilling. And so I mentioned my father had created strategy, and I decided that I really wanted to explore whether it made sense to pursue that instead. That was kind of longer term, more scalable.
Okay.
I really wanted to feel that I was doing more than just simply creating income and having
Yeah.
a positive impact. So I went a different route in I guess I started my company in 2013. So that was right as passive was starting to gain steam.
Mm-hmm.
Um, as far as small caps go, that is a topic that annoys me a little bit, in that first of all, there's a long-term trend just into passive, like nothing seen before. And it can't go over 100% in passive. Right now, the numbers I saw recently was that the percentage of equities that are in passive are over 50%.
Okay.
And the way that human nature generally works is you swing from one extreme to another.
Mm-hmm.
I believe, and we'll see, that we are seeing one such swing to a particular direction. And I think we will see a counter swing at some point. That doesn't mean that passive ownership goes to zero. That could just simply mean that passive ownership goes to 40.
Right.
So we are in the midst, arguably you could say I would say that we're basically 15, 16 years into the longest bull market ever. Momentum has been hotter than any time ever.
Yeah.
And the recipients of that momentum, or the reason we have that momentum, is the amount of indiscriminate money that's just going into passive portfolios, and sort of that machine that has been created where perpetually more and more money goes into the largest of companies. You add into that 0% interest rates, now all of a sudden smaller companies have a significant disadvantage relative to large companies. Large companies were able to refinance massive amounts of money.
Yeah.
At a very low interest rate, excellent terms. They just bought back their stock. Most of them did not create better companies.
Apple issued bonds at 2%.
Yeah.
They
Yeah.
issued long-term paper at 2%.
How does small cap compete with that?
Yeah.
And the problem is that's a structural sort of regulatory issue. So I'm hoping it changes, because frankly, you asked earlier kind of how I feel about that from a sort of a mid-cap perspective. I come from it. The way that I approach what I do in business is I believe that if I do the right things consistently for the right reasons, then ideally everybody wins.
Mm-hmm.
If the client wins, I win. And so when I think of what's been going on, I think of it more broadly rather
Mhm.
than with regard to mid cap. It's more just, I think it's hurting the US. It frankly, it kind of disgusts me. Like the small cap or smaller companies in general, entrepreneurship is what has driven the United States. It's what has driven capitalism and the massive increases in quality of living
Yeah.
over the last, I don't know, what, 100 years or so.
Hmm.
And we are really dampening that as far as making the US economy far less competitive. There's so much money in worthless companies. There's uh, because of 0% interest rates, the biggest companies they have a very low hurdle. They can buy anything. They can shut anything down that even remotely looks like it could be competition.
Yeah. They just buy it and roll it up. Yeah.
Yeah. I just feel like we're hurting ourselves. And as far as small cap, I'm kind of jumping around because this is a broad topic
Yeah.
and I have a lot of opinions on it. Another theme that I've been focusing on more is just I would like people to think more. There's particularly if we think in terms of, we'll say passive investing, but just decision making in general. It's possible to make poor decisions and get a positive result. Over the long run, that's probably not going to be the case. But over a certain period of time, you can. So one of the examples I use is if you're in a hurry, you can drive 150 miles an hour through a school zone and you'll get to where you're going faster. And you can say, man, that was a great decision. But in the long term, if you're driving 150 miles an hour through a busy school zone, you're probably going to hit somebody. And then your life is over. And the risk reward, you're making poor choices. You got away with it for a little while. And then it bites you in the long
Yeah.
run. I think there's a lot of that going on where if we're going to talk about passive investing, just passive has had some very significant positive impacts on in the world in general, right? Like whether it's active and fees have been compressed, which is certainly good for clients. Passive investing has performed especially well because of the momentum, because of the stimulus and
Because of the
0%
market cap weighted nature of it.
market cap nature of it. But if you really think about passive, um, just the way it's constructed, it will be perpetually overweight, overvalued companies and perpetually underweight, undervalued companies.
Hmm.
Would anyone ever say, I'm going to buy more of companies that should probably go down and I'm going to buy less of companies that should go up? No.
Well,
And yet,
that's what I've always said. I said if I explain to you that if a company does well, we're going to just buy more of it, and the better it does, the more we're going to buy, and we'll let the companies that are not performing right now, we'll just let them kind of get smaller and smaller in the portfolio and eventually just drop off. And so we can do that, and I'll just when a company's interesting, we'll just add it to the mix of the portfolio, and if it starts doing better, it'll take up more and more of the portfolio, and we'll just run it. And the better it does, the bigger it'll get in the portfolio. And most people are like, no, I think I'll just stick to index funds. And I'm like, oh, really interesting. Cause that's the S&P 500, this is literally exactly what it is, right? It is still it's actually a quite active idea, right? It's not high turnover, but it's a quite active idea. The 500 companies are selected by the investment committee at S&P, and then it's a momentum. It's literally a momentum strategy, right? So,
yeah,
pure like index investing should be, and to look at the disparity is really easy, right? So just go look at what has done better the last 10 years. Is it because if the theory of passive in and of itself, just buy the market and the market will produce this one return, and, on aggregate or on average, all active equals all passive, right? Then S&P 500 equal weight would be the same return profile as S&P 500. And the disparity or difference between S&P 500, as most people look at it, and S&P 500 equal weight is kind of the momentum factor, right?
Oh
Like you
yeah.
think about it, like that's the, what's the one difference? Well, it's the way that you weight the companies and the momentum factor. And so new money coming in rewards the biggest companies, that inherently reinforces and makes them bigger, which means the next dollars behind them coming in buys even more of them. And creates this problem. And what you're saying is that comes into, well, the companies that have been the most rewarded are now the most overvalued and should, they're sort of overvalued and should go down. And the little guys that were just had good businesses, and were doing good business, but didn't do anything to inflate that momentum factor or game the index, they're sort of undervalued now, and not a lot of attention is being paid to them. Am I understanding what you're saying, kind of how those two things marry together?
Yeah. Yeah. No, that's a good point. The other way that, yes, I think also one, it just doesn't really make, if you really think of exactly how a cap weighted index is constructed and how therefore you're allocating capital.
Sure.
No one would ever say, I want to invest more in overvalued companies and less in undervalued companies, but that's what you do.
Yeah. If you were if you were an active investor, you would say that has gone up in value.
No
I'm going
one
to
who
sell
thinks
that.
like that.
Yeah. I'm going to sell. Well, Warren Buffett thinks that way. I'm going to sell what's overvalued, and I'm going to go buy what's undervalued.
Yes.
Yeah.
Yes.
Uncle Warren
Another
thinks that way.
very simple way to think of, because I like that you compared the S&P equal weight and the S&P 500, is S&P 500 is very much driven by momentum, whereas the S&P equal weight is favored by mean reversion. We just happen to have gone through a period where we've seen basically little to no mean reversion, partially because of artificial stimulus, right? Every
Yeah.
time the market even remotely declines or there's a sniff of a decline, we either throw in QE, we do a tax cut, we pump in $1.5 trillion in stimulus. And so we haven't seen mean reversion. We haven't allowed it to happen.
Yeah.
That doesn't mean it's not going to happen. You can't artificially pump something up that's driven by numbers in reality. You can't pump that up forever.
Yeah. See, the
And
old
so
saying,
if you go back,
trees don't grow to the sky.
no. And if you go back,
Yeah.
I don't know, let's say for like the last 5 decades, these are loose numbers, but up until the last 2 or 3 probably rolling decades, the S&P equal weight outperformed, or we'll say equal weight portfolios outperformed their cap weighted counterparts over every single rolling decade in history.
Mm-hmm.
The only exceptions are the last few years.
Mm-hmm.
So long term, and the reason why that is because the market's noisy. People come in, they buy, stock pops up, people sell, stock goes down. And if you're constantly kind of fading that noise, it ends up over the long term being beneficial.
Mm-hmm.
We just haven't seen that in the last decade. The last decade's been very unique.
Yeah. When I was at the last NAME conference, the National Association of Active Investment Managers, there's a member, Rob Hanna. I don't know if you've ever seen him on like Twitter, Quantifiable Edges. He specializes in kind of trading VIX and volatility. Interesting guy, but he actually put up a slide at the conference that showed the equity curve of like trend versus mean reversion. So it was a relative it was a relative performance sort of graph, right? So if the graph was going up, the line was going up, then at that period in time, you'd been better off buying the market on the day when the market went up versus, selling on an up day, buying on a down day sort of thing. Right. And what it showed was the last 15 years, there's been this huge change where, and I'm going to get this wrong, so maybe I should go find this and pull it up. I'll find it and send it to you, or I'll ask Rob for it. But it was like for the longest time, it was actually trend did really well, and then in the last couple of years, mean reversion has actually, like daily mean reversion, so super high frequency mean reversion's actually worked really well because, and it was he just put it up as like an interesting like, I don't know what changed, sort of thing, or I mean he might know and it just wasn't, he was just trying to stimulate thought in everyone. I think it's actually the adoption of passive has caused markets to become inelastic in a way. And so the market has started overreacting. And so what I mean by that is like, okay, a little bit of news and the market goes up a lot, and a little bit of bad news or whatever, and the market goes down a lot more than it would have in the past, right? The swings have become a little bit more volatile. And so that you get an overreaction and an underreaction in both ways, which opens up the door actually for short-term mean reversion in quite a significant way. And I think you're right that like things eventually mean revert. I am absolutely, I'm with you on that. I don't know what the time frame looks like, but what I know is that passive, here's the thing is like passive isn't necessarily bad. And passive's done a lot of great things. In particular, like myself, if you look at our clients' portfolios, we do a lot of trading in the indexes, right? Because we can, it's easier to trade the indexes, right? It's way less risky. You can capture return more predictably. You can manage risk more predictably than if you had a portfolio of, 20 or 25 names, right? And on top of that, you can scale it out to, stuff that's not ultra high net worth clients, right? It's more scalable and accessible, which I think is great to democratize finance. However, there is a point where the longer kind of the passive, I don't know that I want to call it a bubble, but this passive structure goes on, I think it really does introduce some significant danger to people that are not going to be expecting it to be coming because they're expecting, well, index is safe, right? This index is safe. Well, there's this disparity growing between the historical market return, which would be, more equal weight, and what is that S&P or the Qs or whatever delivering for you. And you're expecting one thing and you're expecting every time there is a dip, you're saying, it'll get bought, right? And that is true all the way up until the point that the passive flows stop, right? And I've talked about this with Mike Green quite a bit. I don't know if you're familiar with Mike Green at all.
I'm actually hanging right now with the Simplify team, two people that work with him.
Oh, okay.
I spent some time with him a few weeks ago.
They're awesome. And Mike's so smart on all this stuff. But it's like, we don't know if that catalyst is the baby boomer generation getting older and retiring and saying, I don't want this much risk in my portfolio anymore. And whether they buy bonds or whether they pull up some of their equity allocation to go buy an annuity, and now it's in the hands of the insurance company, which is not going to just hold it in index funds, right? Insurance companies don't manage their portfolios that way. Does that create that slow grind, consistent outflow, or that at least offsets whatever, kind of consistent bid is coming from people our age working jobs and getting, paid and money going into the 401k and buying passive? I don't know. I don't know what it looks like, but one of the absolute eye-opening things, like when you said, oh, passive can't go to 100, right? Or passive can't go beyond 100, right? You can't, not more than 100% of people can go to passive. I don't think it can even get close. And this is Mike's work. Like, I think he indicated if you're at like 80 or 85% of the market were to adopt passive investing, the forward-looking PE on the S&P 500 would go to 900. You know what I mean? Like that's where it would have to be because of the inelasticity of the surface, right? Like it's ridiculous almost, right? It's just so ridiculous. So how much more can the pendulum go? And that I think is what opens up the case for, it could go a lot further than we're thinking, right? Like it
usually does.
Yeah, it usually does. And, markets can stay, irrational longer than you can stay solvent, right? All of that. And really, I think sometimes it's the markets can stay irrational longer than we can stay, behaviorally sane is probably the real essence of that. But what does somebody do? Like, what are the alternatives? Like what are the other places of the market that people could be exploring or looking at or considering that isn't just, hey, buy S&P 500 and, set it and forget it. And, it doesn't matter if you live another, 80 years, it will just always go up, because I don't think it always will just go up,
No, one thing that concerns me is when you and I, and pretty much anybody in the investment industry, speaks with a client about an investment,
mm-hmm.
two main topics. It's the return and the risk.
Mm-hmm.
If you think about the passive sort of narrative or story. And again, I see passive as a very significant positive evolution in the kind of, let's say, history of investing. I think it's
Yeah.
been a good thing. I just don't think that it's the end goal. There's too many warts that personally I see. One of those is when you and I and anybody else speaks with a client about investment, we discuss return and risk. If you think of the passive narrative, they don't talk risk. It's they only speak return. They say, hey, passive has outperformed 80% active managers over this period of time, which, by the way, I have some issues with the data they're using. I think it's wildly
Well,
misleading. But that's a whole nother matter. I think it's important to realize that passive is selling passive, right? Like we think of passive as this sort of higher power, when in fact it's companies that want to sell passive to make money. But regardless, yes, it's performed well in one, however you cut it.
Mm-hmm.
They don't even discuss risk. The way that risk is addressed is, well, you just buy and hold. You don't,
You never lose money if you don't sell.
It's just going to go up.
Well,
Just buy and hold. But the problem is, if you think about baby boomers, the sequence of return risk is massive.
yeah.
Like if you are just buying and holding, and then you're approaching a period of time where you're going to need to access that money and use it.
Yeah.
And the market declines, which happens probably, it used to. If that happens and you pull money after a big decline, that destroys your cumulative growth over the long run. And so there's this very important, there's only two big aspects that we discuss, return and risk. One of those has been entirely glossed over. And it really concerns me that a lot of people, if we think of baby boomers, there's a lot of people that are not aware of the risks.
You know what's interesting though is that what I will tell you is that my larger clients that have more significant capital invested, and they're in a better place in life financially speaking, their conversation is oftentimes very little about the return. It is not their concern. They're like, what are we doing now? Like, we know we have to be invested because that's a game we have to play over the long term. So we get it. You don't have to sell them or convince them like, yeah, you got to stay invested. Don't sit in cash. But their conversation focuses, what are we doing to protect the capital? How are we managing this risk? Right? What are we doing to, like what if the market is down? What are we doing? What are we implementing in the portfolio to try and get a return outside of, just, hey, does the market go up over time? Right. And that is a conversation that they're oftentimes way more interested in. They're way more interested in the risk side. And it's unfortunately, the crowd that traditionally was, you would more traditionally think like that's somebody that probably just has a pension, right? Like that demographic of people that they ended up with a 401k. The 401k told them, set it and forget it. Markets go up over time. And
what could go wrong?
Well, and there was some volatility laundering that I think sort of almost happened in the 401k industry, right? Which is, because I've talked to people that say like, oh, my 401k never really has gone down that much. Or I've talked to people that said, oh, I've always been invested and I've always been aggressive on my 401k. And in 2008, I didn't lose a lot of money, and I went, interesting. And I just do like a little bit of quick math backwards. And I'm like, because your contributions in 2008 were able to completely plug the hole of the losses that you would have otherwise been seeing. So your account balance didn't go down, even though the value of your assets were. And in the long run, you were doing absolutely the right thing, right? They were buying the dip and it's worked out and it was great. But what it leads to is this complex or profile of like markets just go up over time and it's fine. And so I think 401ks, because of the constant flows and the constant purchase, until they get to these larger balances really late in their career when they need to take it serious and they really need to be looking at it. It hasn't been too scary of a thing because if markets go down a little bit and, new money's coming in, you're kind of always looking at it going like, well, says it's crashing, but it doesn't seem so bad. It's like, well, yeah, you put a bunch of money in last quarter, um, and so it recovered quick. The problem though that you're identifying is once somebody gets to retirement age, that paycheck stops. There's no more dips to buy. Where are you getting the cash from to buy the dips? Right? What is that recovery?
And you're pulling it out.
Yeah. Oh yeah. Well, that's the other edge of the sword that cuts extra deep. Right. And have you heard of like, are you familiar with Michael Kitces?
Yeah.
At all?
Yeah.
Like, have you heard of his like tent allocation idea?
I'm not. We're not really in planning. I haven't.
Yeah. Well, it's okay. Well, it's an allocation concept that he kind of came up with that said, as people come into retirement, they should consider owning, more and more bonds, like, glide path into owning more fixed income. And then as they retire, after the first couple of years of retirement, they start glide pathing back out of bonds. And so once they're like 10 years into retirement, they don't own bonds anymore. And the idea being like you're owning bonds in this middle, you're kind of tenting up a portfolio with bonds, if you will, to manage that sequence of returns risk right in the middle where it becomes the most impactful, right? If you're already been retired for 10, 15 years, you've allowed the portfolio to grow so much that, even if you have a drawdown, you're probably still so far ahead potentially than, if you own bonds the whole way, right? It's kind of the theory. It's just a theory. All I'm saying is at least somebody put some thought behind it, out there.
No, I like it.
I'm not saying it's right. I'm not saying that's what people should do, but there is a whole conversation to be had around this sequence of returns risk. And if you go and get absolutely smoked in the market, and I'm not talking, listen, if you're down 5, 10%, that's nothing. Like that recovers just fine, and candidly, the way that I tend to set that up for clients is like, what money do we see needing to come out in distributions in the future? And you run that less risky, right? And you run that with less volatility in some manner, right? And you're kind of prepared so that way you can give the distribution and then take, and rebalance the portfolio more strategically, right? But if you go get smoked by 30, 40% drawdown or 50% drawdown,
yeah,
dude, you're wrecked. That's not something that you get to recover from in retirement. Like that is life changing. That is, hey, you're go
talk
ahead.
about because it's so simple is if you lose, and these are just simple round numbers to make to illustrate this issue.
Mm-hmm.
But if you drop 50%, you have to double your money to get back to flat. It's really hard to double your money.
Yeah.
If you experience a 30% decline instead, you only need a 40%, which is still a big number, but we're talking, so 30 to 50, that's a 20% gap, right? It appears that the difference is
not that much
significant, but in order to be making new highs, it's 40 to 100% gap, right? Yeah. So that's how much each incremental increase in that drawdown matters, right? It's 40 versus 100 to get back to new highs because of that, 20% differential in the drawdown. And again, it just shows sort of the magnitude of an impact that larger drawdowns have.
Yeah. The danger zone, in my opinion, for most people really starts at about 20% down. Kind of once you get past 20%, that math really starts to look quite unattractive and you know what I mean? Like unrealistic to a quick recovery. Right. And that's
but also you add in human behavior. That's the other thing that concerns me with the passive narrative is it assumes that people will never sell and that they'll just keep putting money in, but that's not how people work. I mean,
that's not how life works.
It's not how life works. But especially today where so many people are, whether they're aware of it or not, might have a massive percentage of their net worth in passive, right? They're not truly diversifying. If we experience a meaningful drawdown, it's going to have a very significant financial impact and emotional impact. And to think that they're just going to sit there and have the fortitude to either sit through it or even add to it.
Yeah.
there's so many studies that show that that's generally not how people behave.
Yeah.
And so it's one thing to hold through it. It's another thing if you sell at the bottom or the worst place, which is very often how I've done it personally
Yeah.
when I was younger. So
Yeah.
I've experienced it. Um, it's human nature. And it's just completely overlooked. It's an important factor that is ignored.
So do you think that there's parts of the market that have outsized opportunity relative to the passive market if the passive market started to come unwound?
Well, one of the things I focus on a lot is just simply mid cap. I mean, it's important to remember that the difference, the lines between small and mid and large are made up numbers, first of all, right? So we talk about mid cap, it's really just whatever, right? That's a general
What
area of the market.
what are like just so people understand this, like what are some examples of like a mid cap company? Like we say a mid-sized company, but there's companies I know that I've said to people before and that are like a small cap name. They're like, that's a huge company. I'm like, that's a small cap company. What do you, um, like what are like, just what are some examples like household names that might be small caps, some household names that might be mid caps and, a couple household names that are like large caps, just for the sake of, you know,
I don't really think in those terms because we deal with mid and large, and so that's a very fuzzy difference for me. But there's obvious examples where it's, let's say Apple, Amazon,
yeah,
JP Morgan, if we don't want to just do all big tech,
yeah,
Visa, Home Depot,
yeah.
Lowe's. A lot of these names are the largest, right?
Yep.
They're the
Hmm.
top,
The
let's say the top.
Walmarts, they're Walmarts. They're huge. They're everywhere.
Yes. And then you work your way down to names that there may be a little more nichey. So
Hmm.
I always have fun just when I'm driving on the road, I'll see trucks or I'll see signs, and it's companies that we invest in that people probably see all day, every day, uh, that they just don't realize. They don't really equate the companies they can invest in to the companies they see every day. So, like
Yeah.
one example is Cintas. Cintas is not in our, well, we do not currently invest in Cintas, but it's they do uniforms
Yeah.
for everybody.
Yeah. Yeah.
And I mean, they are
Yeah. They
everywhere.
got the green trucks, right?
Yeah, and so companies like that are big names that you see everywhere that have done really well over
Hmm.
the long run that you just may not notice. We've got, let's say, one of the companies that we are asked about on a regular basis is Texas Roadhouse. There's these companies, you asked about companies that could do really well if passive struggles. It's passive because of the momentum factor, because emotions. If you really think of the way that investment and passive works, is you can see my armband from the College World Series that I got talked into going to right now. Passive. So right now you've got the percentages that make up the portfolio.
Yeah.
You put more money in the largest ones, less money in the smallest ones. But if someone is like, hey, I really love uh, my Tesla, and they buy more Tesla stock, now all of a sudden the percentage, now, yes, it might be a small bump, but if a lot of people do this, now all of a sudden the percentage that Tesla makes up of the S&P is greater. So now every single person that buys passive now buys more Tesla. And then if someone else is like, oh, I like Apple, then Apple bumps up. And then every single person that buys passive buys more Apple. Not because Apple did anything fundamentally to be a better
Hmm.
company, but because someone else was like, oh, I like Apple. Apple's a cool company.
Yeah.
Right. And that's where you can find companies that are probably going to do really well if passive does struggle, because there's a lot of companies that are on the opposite side of that, where people have never heard of them. So
The
they
boring
never
stuff.
receive that bump. And so they never receive that extra money that goes into it. And so they've got there's perpetually less and less money going
Yeah.
into these companies that might be performing really well. And it's simply because people aren't as excited about them. So I mentioned Texas Roadhouse. So not the best of it's a nice enough restaurant, but it's not going to get people really excited. Not
Hmm.
like Amazon or Nvidia, right? And because there's so much money flowing into those companies and the index, and so little flowing into companies like that because they're boring, you get this huge disparity in valuation where now all of a sudden, if numbers really do matter, which we're dealing with money, in real businesses, I would say they matter. Um, at some point, you're going to have you have a lot of companies that should go down
Yeah.
because their valuations simply don't make sense. And there's a lot of companies whose valuations should go up. And it's all because they haven't participated in what's been going on. You've got this sort of pent up alpha.
But their participation hasn't been anything because they per se didn't do like they weren't intentionally excluded. They were just inadvertently excluded because they lacked having the momentum in their specific name enough to catch the indexation wave, so to speak. Right?
Yeah. Yeah.
Like it's not because they're a bad company and they said like, oh, well, you're not going to be bought. It's just
They
like
might be performing really well.
the underlying company.
Yeah.
Yeah.
Yeah. It might be great company. Right.
Yeah.
But let's say whatever. Let's say you have a company that goes in and cleans library books, right? Nobody's gonna be like, oh, that's exciting. I want
Yeah.
to put a ton of money in there. But what if they're going in and they're cleaning every single library book in the US and they're killing it?
Yeah.
Nobody's investing in that because it's boring.
Yeah.
And that's where you have that potential because you're getting something of value cheaply.
Yeah. Well, that's the old saying, right? Price is what you pay and value is what you get. Right. Which I think is a Warren Buffett quote.
I mean, he has so many good ones.
He's got a lot of good ones. Old Uncle Warren. I say that all the time. I might have ripped that off from old Uncle Warren himself. But it's totally true. So, by the way, for like the mid cap thing, I'm from Wisconsin, so my go-to is always Kohl's,
Yeah.
the department store, right? Everyone's like, oh yeah, they do exist. And they're actually
What's
like in every
funny,
town. No one really thinks about them otherwise, right?
those discount, who wants to go? Most of the time when I go into like TJ Maxx, and you can find some cool stuff, but man, it's a disaster, right? It's very rarely a pleasant experience to go into Kohl's and TJ Maxx, but they're doing something, their business is clearly very valuable. They're providing significant value to their client base, but
Yeah.
then the companies are performing really well, but they're not exciting, right?
Yeah.
You don't go into
You don't brag to your
Kohl's.
friends at a dinner party that you own a bunch of stock in Kohl's,
No,
right? You brag about owning Tesla. You brag about owning Nvidia. You brag about that stuff.
yeah.
No one says I own Cintas and Kohl's
No
in my
one had a
portfolio.
pipe or a cigar in their mouth and said, I own a lot of Kohl's.
Yeah.
That's never happened.
Yeah. It should make. Well, I don't know. Like, well, I don't think Charlie Munger smoked, but that probably would have been a Charlie Munger thing. Rest his soul.
Charlie Munger.
But anyways, yeah. So it's just funny. So you essentially you think the edge is going to lie in deep value, in good quality value in the long run. That's what would prevail according to your thesis.
I don't even know. I wouldn't say deep value. If we're going to keep going the Berkshire train, Warren Buffett initially was looking for good companies at great prices.
Mm-hmm.
And at some point, Munger got him to evolve and look for great companies at good prices. For me, that has always made more sense. Deep value generally means looking for something that is sort of left for dead, that is probably struggling as a company,
Mm-hmm.
and you're looking for a turnaround. And if you can do that effectively, awesome. Like you'll do well. But what I would say is much easier and more likely to be productive is finding really good companies that are doing really well that people just aren't as excited about right now. Or you can simply get them at attractive valuation. So it's not necessarily deep value.
Just
And that kind of brings us
that good
full
value.
circle to one point that I wanted to come back to make because you asked about small caps. I would like to see people invest with more, well, maybe even live, but invest with more thought and common sense. Um, we are inundated with data, whether it's on passive or whatever,
Sure.
and these different narratives. I would like people to, I hope that at some point people take a step back and just think. The thing about small cap and let's say deep value, so if we're talking about from a factor basis, uh, value is generally that's companies that have a low price to book, which usually are
Okay.
fairly distressed. Small cap, as of right now, I don't know the percentages, but let's say 50% of small cap companies are unprofitable. Um, those are going to probably really struggle if we go through a recession. Like you don't want to be in companies that consistently don't make money. There's also a good percentage that are zombie companies.
Yeah.
Then on the value side, again, if you're looking at deep value, they're distressed. You don't want to undistress companies when you go through distress. But one of my issues with small, and the reason why you brought up before is coming into the last decade, everybody uh, said, small outperforms large, small is the place to be.
Right.
But it just never clicked with me. Why? Like, it doesn't make any, the rationale behind that is, well, you invest in smaller companies, so you deserve a higher return. What, in what way are you guaranteed a higher return just because you bought a smaller company? That makes, there's kind of a leap of faith there. It
Yeah.
doesn't make sense. Whereas if you go to mid cap are companies that have kind of proven themselves. They've graduated from small to mid.
Mm-hmm.
So they've got that margin of safety, right? They've got a legitimate product, but they're still small enough that all it takes is one more product and all of a sudden maybe they double. Mid cap is sort of that sweet space that balances that, again, that margin of safety because they're established, but also that upside because they're not massive.
Yeah.
Um, I don't know. Personally, I think that small doesn't make sense, at least as a factor and
Hmm.
as like sort of I guess if you think of kind of an index or diversified portfolio. And I also think that value. So, the whole Fama French uh, narrative, yes, it was driven by data, but I think those will perform really well coming out of a recession.
Mm-hmm.
Going into one, I don't, or whenever one occurs.
Well,
I think it's going to continue to struggle.
I think if I remember their research correctly, it's the small cap value factor that outperformed, and I think the general thesis on that was or has been interpreted as, they're these small companies that are boring, like you were saying, and they have some kind of durable business that can't really be rolled up in some way. Right? It's tough to roll them up. And as that's underperformed, one of the things that I've thought about in my head is like, well, in the past, maybe it was hard to roll it up, right? Like in the past, maybe it was hard to do a merger or scale it bigger and become a mid-cap company. But now what you have nowadays is Apple just issues debt at 2% on long-term note and just goes and buys that company. And now it's just a subsidiary of Apple.
Or they just kill it.
You know what I mean? Yeah, right. Yeah. Or they say that's a competition. We'll just buy it and shut it down. But I guess that's what I'm saying is I think that I haven't looked at really any hard data, but it's something that I would be interested in exploring if there's anyone out there that just like specializes in looking at that. You'd have to probably really dig. But I think that's something that could have been playing into the whole thing right along is like, oh, a company looks interesting. There's a bunch of durable value there. It's unscalable, but it's really, crucial to our business model as a larger business. We'll just buy them because as a larger company, it's been so easy with low interest rates to just issue paper, buy them, done. Right. And now that company doesn't exist in small cap land. It just exists as a subsidiary of that mid cap or large cap or mega cap company. Right. And the other thought I had is if we were to go into recession, I really wonder what the value or like the alpha proposition would look like if you went long, like S&P 600 value and short Russell 2000. I wonder what the alpha play on that would end up looking like. I don't know.
I think that the sweet spot
I'm not saying that's a trade, not an investment.
I
But
love it. I love thinking about these different things. But one of the concepts that I've really been focusing on a lot lately, and it's really simple, is just simply it's the idea of investing where others aren't.
yeah,
Um, you know, large cap growth, passive, which are sort of the same thing. That's You could argue that that might be the most overcrowded trade in history.
it and the only scary part is it could stay overcrowded for an unreasonable amount of time from a behavior perspective.
Yeah, definitely. Unless we need a catalyst to change that behavior.
Yes.
But, so going back to mid cap, there, according to different things I've seen, mid cap is the only area of the market that's actually undervalued relative to its long-term mean CAPE ratio. So even small as, at least according to the metric, is arguably overvalued.
Hmm.
Large is, according to that metric, 50 to 100% overvalued. And so going into a recession, investing where you already have that margin of safety, where if things do go down, something that's already undervalued and should go up, it shouldn't go down very much because it should go up. Whereas the
Yeah.
other areas, particularly large, if it reverts to its mean, should go down and potentially a lot.
Well,
Um,
I think something important to just call out for anyone considering looking into this type of idea, right, is that when markets do go down, because it's always a matter of when, not if, right? Markets will go down. It won't stay down necessarily, but believe me, they go up, they go down, right? There is a saying I live by, which is the one thing you can bet on going up in a bear market is correlations. And so as maybe all those overvalued companies sell off, remember that they're included in indexes. And in those indexes, there might be some of these other names that you invest in. And so as they're selling their index positions, their passive positions, that is still selling pressure and will still push down the value, the price, not the value, but the price of these other stocks that you're saying are somewhat undervalued. Now you're saying because they are so undervalued already, or there are a fair value, there's this effect where more people, more owners of the stock would look at it and say, I'm not selling. I own it at a great deal, like maybe this is my opportunity to buy more. But that doesn't mean that just because there is a relatively attractive valuation today, doesn't mean it won't go down when the market goes down. It just means expect some kind of outperformance. And that outperformance doesn't mean day by day. It might mean maybe it goes down at a relatively similar rate or magnitude of the market, but it's going to be such a deep value at that point. It's going to be so oversold from a valuation perspective that it should recover. You would expect it to be able to recover okay in the long run and probably recover quicker.
The only thing I'd add to that is in 2000, which I think in a lot of ways is probably the most similar to sort of the way the market's evolved recently. In 2000, you had a lot of money chasing a small number of companies, and then you had a good number of companies that just sat there and didn't really participate. In 2001, when the S&P was down significantly, when the NASDAQ was down significantly, value, high quality, small cap, I think might have actually all been up. I mean, they performed really well. Now that's an anomaly. So I would say don't count on that because yes, correlations rise, people sell everything. But, today, so while I wouldn't say expect those areas that are underinvested to be up, I would say again, if you think back to index construction, and yes, one of the things that's driving this is the popularity of indexes.
Yeah.
But those holdings are a much smaller percentage of the indexes. So will there be selling? Yes.
Yeah.
But there's far less selling, right? There's Fiserv is a good example. I think Fiserv's, I don't know, let's call it $130 billion market cap. At least that's what it was several months ago. It's only, I mean, it's a big company, right? $130 billion company. It's a quarter of a percent of the S&P, right? 25 basis points.
Mm-hmm.
Whereas Apple's what, like 8 or something at this point.
Yeah, 7,
And
8%.
so the amount of selling, at least as far as the magnitude, is a drop in the bucket. I mean, it's tiny relative to
Yeah.
Apple. Now, yes, the company's smaller, but the other thing is, if we were assuming that only that everybody's behaving in conjunction, and yes, correlations are rising, which is sort of what that means. But if we take a step back, there's plenty of people buying and selling in bear markets, right?
Hmm.
There will be money being put to work. And the question is, if people are beginning to really consider risk and valuations and the quality of
Yeah.
companies, where are they going to put new money to work?
Yeah.
They're going to put it in the best companies at the best prices.
Yeah. Well, and I think you know, what I'm highlighting is if you're going to value invest, realize that that doesn't mean that under, no circumstances does the stock ever go down, or does it mean
Yeah.
that it can't go down an uncomfortable amount, right? Like it can go down and it can go down an uncomfortable amount. But that's the time, if you're a value investor, you got to really check yourself in the mirror and say, okay, what do I own? Like, what do I own right now? Why do we own it? And what's the value of what we own, right? Because if the price is just down, then you have to put your Warren Buffett thinking cap on for a minute and say, if the value is $100 and the price says $80 he would have probably said on my quote machine, but on your app, right, or whatever, it's probably not a good time to sell. Yeah, it's like you got to be able to look at yourself and say, okay, look, there's a dislocation in the market going on right now. It's uncomfortable. And now it's freezing me up as an investor that, like, if I need a distribution or I need to sell because I have something going on in my personal life, hey, I shouldn't right now. That would be a really bad time to sell. But that's where good financial planning comes in. And, like, hey, have a more complete strategy than putting all of your eggs in one value basket.
Yep.
But I'm from Culver, so now I'm thinking about fries and value baskets. Oh, I'm not from Culver's. I'm from Wisconsin, and I love Culver's.
Butterburger.
Oh, yeah. The chicken tenders are where it's at, really. But anyways, so if you're going to, like, my reminder to people always, if you're going to value invest, like, remember what you own, not what the price says is, you know what I mean? Which is counterintuitive to oftentimes how I invest or manage. But, think about what you own from an intrinsic value perspective. And I think that's what makes the volatility of stuff like Bitcoin so crazy, is like there is no way to value the intrinsic value of Bitcoin. It is entirely based upon the next guy wanting it as bad as you did, right? Like that's it. There's no real estate they own, that you can touch. There's no infrastructure. There's no government contracts. There's no cash flow.
There's no baseball card you can look at even.
Yeah. There's nothing, man. Like, which is fine. I'm not an anti-Bitcoin person, right? I'm very agnostic in investments in general, right? My philosophy is like, what's the situation we're in and how can I profit? Because that's what my job as a good investor is. But if you're going to choose to go down a certain, pathway as an investor, know what the pros and cons are, right? And the con of value investing is sometimes there's nothing that says it has to make you a great return in any given quarter or year, and there's nothing that says it can't go down, right? There are those dislocations, and being able to lean on, hey, internally, whether you get it in an ETF, right, that focuses on this type of idea, and you can say, okay, well, in that ETF, we own these kind of companies, and this is why they own these kind of companies. It'll be okay. I trust the managers. You can do that, or if you're, one of the brave souls that wants to pick individual names, like, really understand why you own it. Better have a good, deep, analysis done and good understanding of what it is that you own, why you own it, so that you can read that and make it through, because those tough days will make the difference. So, yeah. Well, I think we burned way more time than I originally planned.
Sorry.
And no, you're good. I want to be respectful of your time, Seth. You've got things to do. You're shimming back to the hotel for us today. So we appreciate you taking out the time and talking to all of us. For anyone listening, Seth, you have a Twitter if anyone wants to, follow you or learn more. Where's the best place for somebody to kind of find you?
I'm a little more active on LinkedIn, so you could just look up Seth Cogswell.
Okay.
Also welcome to simply email me at seth@runningoak.com if you ever want to discuss any of the topics that we just covered. But yeah.
I will tell anyone listening, if you email Seth, expect some kind of joke in the response. He's one of the more well-humored portfolio managers I know. So that being said, thanks again, Seth, and we will see all you guys out there.